If your goal right now is to make $2,000 a month from your dividends or $24,000 a year, and you can get a 24% dividend, meaning a 24% return on the cash that you invest, that means you'd only have to invest $100,000 here into SCU or $150,000 here into ORC to get these types of returns. Now that's not a lot of money considering that typically you would need to invest at least $500,000 to be able to comfortably make $2,000 a month in passive income. So to get that with just $100,000 or $150,000, that's a pretty good deal. So what's the catch? Dividends only show you a piece of the puzzle. When you invest your money, you should not only look at the dividends, you have to look at the company in general, and a dividend is a piece of what the company does. So if you're only looking at the dividends, you're only looking at a piece of the puzzle. When you invest in a company that has super high dividends like this, that typically also comes with very high volatility. That means you can see the stock go up and down, and in order for you to really see and maintain these types of returns, you want to make sure that the company that you invest in isn't going to suddenly tank tomorrow. And when you have these type of dividends, you're going to see a lot of volatility up and down in the stock. And another thing that you want to remember, which becomes extremely apparent when you invest in a company with super high dividends like this, is when the dividend is paid out, many times the company's stock price will fall by the amount of dividend that is paid out. So if a company is trading for, say, $100 a share and they pay out a $3 dividend, the day that the dividend is paid out, many times you're going to see that company's share price fall to $97. This is a lot more apparent when you have these super high dividends, because now when you pay this big dividend, the stock price falls. So if you get this 24% payout, sometimes you might just see the stock price fall by 24% because of the dividend that is paying out. So you need a strong company that can help drive up the stock price in addition to just paying the dividends. The second way that you can invest your money to get that dividend passive income is by looking for growth. Now typically when we talk about growth, especially when we talk about stocks, we're talking about investing your money in a stock that's trading for $100 a share today to hopefully go up to $200 a share sometime in the near future. But when we talk about dividend growth, it's a little bit different. When we talk about dividend growth investing, now we're talking about investing in a company that's paying out a dividend that's growing year after year after year. And you have a few different types of dividend growth companies. You have dividend challengers, sometimes they're referred to as dividend achievers. You have dividend champions, sometimes they're referred to as dividend aristocrats. And then you have dividend kings. All this means is a dividend challenger is a company that has consistently been paying and increasing their dividends over the last 10 years. A dividend champion is a company that has consistently been paying and increasing their dividends over the last 25 years. And a dividend king is a company that has been paying and increasing their dividends over the last 50 years consistently. A few examples of dividend challengers are JP Morgan Chase Bank, Apple, and Pfizer. Both JP Morgan Chase Bank and Pfizer pay around a 3% annual dividend at the time of recording, and Apple's paying around a 0.5% annual dividend. So again, this means that these companies have been paying dividends and increasing them steadily over the last 10 or so years. And if you want to get that same $2,000 a year in cash flow and you're getting about a 3% annual return, that means you'd have to invest $800,000 to get the $2,000 a month in dividend cash flow. With Apple, who's only paying a 0.5% annual dividend, you'd have to invest significantly more. You'd have to invest $4.8 million, but that's because their dividend is only 0.5% a year compared to the threes. A couple examples of dividend champions are IBM and J&J. IBM at the time of this recording pays around a 5% annual dividend, and J&J or Johnson & Johnson pays around a 2.5% annual dividend, which is around the JP Morgan and Pfizer dividend yield. Now with the 5% annual dividend, you'd only have to invest $480,000 to get the same $2,000 in cash flow a month. And then we have the select few, the dividend kings. These are the companies that have been paying and growing their dividends steadily for the last 50 years or more. And a couple examples of that are Target and Coca-Cola. At the time of this recording, Coca-Cola is paying just under a 3% annual yield, and Target is paying right around a 1.5% annual yield. If we do the math, at a 1.5% yield, you'd have to invest $1.6 million to get that $2,000 a month. And at the 3% annual yield, again, you have to invest about $800,000 to get that same yield. The third way to generate this type of dividend cash flow is by investing your money for value. So up until now, we've been talking about investing your money solely for the dividends. But another way that you can invest your money is investing your money into value-based companies. A value-based company is a company that is profitable, that has good fundamentals, that's creating a good product, and that's innovating for the future. Now you're investing in this company because you like the company, you believe in the company, but one of the benefits of investing in this company is you get paid a dividend as well. So you don't get necessarily the biggest dividends with these value companies, but you're investing in a strong underlying fundamental company. The reason why I'm talking about value companies instead of growth companies, not growth dividends, but actual growth companies. These are your smaller startup techie type companies. These smaller startup techie type companies usually are not profitable. They're spending every dollar that they can and sometimes more through the help of debt or investment dollars. That way they can grow bigger and faster to grab market share. So if they don't have a profit, they can't pay out a dividend. As opposed to these value companies, these are typically your larger companies that have already established that market share. These are your brand names that everybody knows. A lot of them are the dividend paying companies that we just talked about, like Starbucks, McDonald's, Pfizer, Coca-Cola. These are all dividend paying companies that are also value companies. But what you're investing for here is not necessarily the particular dividend, but the underlying value of the company. So if you don't want to do all the research or doing the fundamental analysis of a company, the next best thing is to invest in an ETF that gives you exposure to these type of companies, and that would be something like VOO or SPY. Both of these are S&P 500 ETFs. I have some of my own money personally invested into VOO. They both give you exposure to the biggest 500 companies on the stock market. That's what the S&P 500 is. So when you invest in VOO or SPY, you're investing because you want to get exposure to the biggest 500 companies on the stock market. But one of the benefits that you get kind of as a side benefit is you also get a dividend. At the time of recording this video, you get approximately a 1.3% annual dividend for investing into these S&P 500 ETFs. And the fourth way that you can invest for this type of dividend income is by investing your money in REITs, which are real estate investment trusts. These are types of stocks in the stock market, and the reason why I give REITs their own category is because REITs follow some unique rules. So the way that these companies work is these are companies that go out, they build and they buy real estate, and they make money through rent. So tenants live in these apartment complexes, they pay rent to the company, and then this company makes a profit. Well, these companies are required to follow the 90% rule, which says that they're required to distribute 90% of their taxable income, meaning their profit, over to shareholders through dividends. So these companies are required to pay out most of the profits in dividends, which is why many times you're going to see REITs pay out higher dividends. So if you're looking for a way to invest in real estate, I personally am not a huge fan of REITs. I like investing in actual real estate. But for the people that love investing in stocks, they like REITs because it gives them exposure to real estate without having to actually invest in real estate. It's not for me, but let's talk about REITs for a second. A couple examples of this, again, I'm not telling you what to invest in, just a couple examples, is SPG, Simon Property Group. This is a very popular REIT. This is a company that invests in real estate, and at the time we're recording this video, they're paying around a 5% annual dividend. Now, the alternative to invest in individual companies would be to invest in an ETF. Again, this is another Vanguard ETF. VNQ is the Vanguard Real Estate ETF. This is an ETF that invests in a bunch of different REITs, and at the time of recording, VNQ is paying around a 2.2% annual dividend yield. So a couple ways that you can get dividends from the REIT sector are one, through investing in individual companies, or by investing in ETFs that give you exposure to REITs. The last thing that I want to mention about this, which is arguably the most important thing, is no matter what strategy you pick, if you want to succeed with a dividend strategy, the key is not to just invest all of your money today. The key is to be a consistent investor. That means you create a system where every week, every 2 weeks, every month, you find whatever it is that you want to invest in, stocks, ETFs, and you're just going to keep investing your money into these stocks and ETFs. That way you can build up your portfolio over time, because most of us don't have a couple $1 million just laying around in a bank account to just go out and make a big purchase. So what you want to do is you want to create a system where every time you get paid, some of your money is automatically buying whatever it is that you want to buy. If you enjoy the shorter clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to invest your money in real estate, our team put together an amazing guide on real estate investing. This guide goes over what real estate investing is, how to start using real estate to generate cash flow, and how to build wealth with real estate. This guide is completely free when you sign up for our daily newsletter. So if you want to read our guide on how to start investing your money in real estate, you can download that guide just by clicking that button right over there. Thank you for watching, and as always, keep hustling.